Chairman of the Hyderabad branch and CA Uppalapati Sharan Kumar, Sikasa co-chairman, and today's speaker Arun Kumar Mantri, and all the participants to this program. Now I request CA Deepak Ladda, Chairman of the branch, to give welcome address and overview of the program.
Thank you, Secretary Ravi Shankar Reddy. Speaker of the day, C. Arun Kumar ji Mantri, our Managing Committee, Sikasa co-chairman Sharan Uppalapati Sharan Kumar, and all the members who have already joined by this time on sharp 6. I welcome you all to the today wonderful topic, how to analyze Indian equity market in the current scenario. Stock market is very close to many of Indians, especially the chartered accountants, because it is a subject which we feel we know, and when we enter, we feel that it is not our subject. So we have to have the clouds clear on such an important topic. We have a renowned speaker and the expert in this subject, who is a regular columnist as well as speaker in various news channels, Mr. Arun ji. Thank you, Arun ji, for agreeing to take on this important topic on technically as well as fundamentally, as how should we read the market and what should be our analysis to take it up and take it up forward. Sir has been regular on the CNBC and other programs and giving his views on the technical charts and other things. So when we approach on behalf of Hyderabad branch, sir has readily agreed to talk on this subject. I hope this will be a wonderful session for next 2 hours, and looking forward for your continuous support, and please join on all the programs which Hyderabad branch hosts. So it will be motivation for the managing committee to host the continuous program. Thank you for the opportunity. Over to the secretary.
Thank you, Chairman sir. Now I request Uppalapati Sharan Kumar, Sikasa co-chairman, to give a brief about this today's speaker.
Yeah. Let me take the privilege to introduce our today's speaker, Mr. Arun Kumar Mantri. He was previously worked as a senior research analyst with Carvey Stockbroking Limited with an industry experience of over 10 years. He is a graduate in commerce from the Osmania University benchmark and a fellow member of Institute of Chartered Accountants of India. He and his team at Mantri FinMart, which is their SEBI registered RIA, has developed expertise in formulating investment strategies, predicting market movements, and generating investment recommendations. Their team primarily responsible for analyzing, conducting market research, and interacting with the internal clients. Among the equity universe, their views on sectors and stocks, indices, stock-specific views, economic news, and global market trends broadly considered. They, as a team, also developed expertise in the field of technical research, portfolio management, and advisory. Their team also specialized in research assistance to retail investors through self-made trading ideas. They are also in the media presence of selected TV channels on regular basis to deliver research recommendations and trading strategies for market participants. Their team have also presented 120 plus investor awareness seminars pan-India on financial market, derivatives, and investor protection. With this brief introduction of our speaker, Mr. Arun Kumar Mantri, I am just put before all of you. Over to you, the secretary, sir.
Thank you, Sharan Kumar. Now I request the speaker to take up the topic.
Before that, I recognize the presence of our past Central Council member, J. Venkateshwarlu, sir. Sir, thank you for joining. Over to the speaker.
Okay, thank you very much. First of all, I want to thank Deepak Ladda sir for inviting me to this investor awareness program. This is the first kind of investor awareness program which I am conducting in the institute, that is Hyderabad Institute. So first of all, thank you very much, and I will also thank the other 2 speakers who have introduced me in this session, Mr. Ravi and Mr. Shravan. So let's start with our program today. So I'll share my screen. Okay, am I audible to all? Am I audible?
Yes, sir. You can go ahead.
Okay. Okay. So today's topic, as we are seeing in the slide, how to analyze equity market in current scenario. See, I have chosen the topic and the tagline because there are three words you can see here: how to analyze Indian equity market in current scenario. So three words are analyze Indian equity market and current scenario. These are three words which are very important in today's session, because the today's 2-hour session, it will be around these three words only. First is how to analyze, second is way to analyze, that is the Indian equity market, and third is the time when you have to analyze, that is the current scenario. So these are three words you should definitely keep in mind, that how to analyze, way to analyze, that is the Indian equity market, and the time where you have to analyze, that is the current market scenario. See, before going to the topics in this presentation, first of all, I want to give a disclaimer that whatever stocks or any mutual funds or any stock ideas or any other recommendation which I give as an example in this presentation or in this session are purely for educational purpose. There is no investment advice or any buy or sell ideas or any stocks. The company names or any other levels which I give in this session are purely for educational purpose. So should not trade or invest on behalf of it, because this is purely for educational purpose only, or all the stocks and mutual funds which are going to discuss in the next slides. So coming on to the presentation. So this is a new era of financial world. Our era has started from 2000 to 2022 as far as my financial world is concerned, or the chartered accountants which are there in the field right now. From 2000 to 2022, this is our financial world in the world of equities. We have seen the markets of 2005, we have seen the market of 2000, we have seen the downfall of 2008 when the lemon crisis has happened, markets have a double lower circuits. Then again, we have seen the rise in 2014, we have seen the fall in 2016. Again, we have seen the fall of Corona. Again, we are currently seeing the consolidation. So before going into the deeper topics, just what are the two rules which we follow in the market whenever we advise the clients are. First is, whenever you are in the market, never be pessimistic. The word pessimistic means never be a negative person, always be a positive person in the field of financial equities, especially for the persons who want to be an investor or who are advising to any investor. Just you have to be optimistic. You should not be pessimistic. You should always think of positivity in the market. If you are a negative your thinker, if you are thinking negatively about the markets, you are not in the right direction, or you are not in the right field. The first and foremost rule in the equity market is you should be optimistic. You should never be pessimistic. You should always think positive. No doubts there will be many negative triggers which will come in your investment journey, or whenever you advise your client for investing, or you do investing for yourself. There will be definitely some negative events. There will be some negative triggers which will impact your portfolios and equities. But you should be always pessimistic. You should not be. You should always be optimistic. You should not be pessimistic. Never think negative in the market. Because if you are investing in stocks, you want your stocks to go up. You want your portfolio to go up. You never want your stocks to come down. That is why invest in the companies which are good in terms of profits, in terms of management, in terms of regulatory requirements. So we'll go to this all those companies later. The first rule is always be optimistic. Second rule is never firefight with the market. So whenever you are investing in the market, never go in the other direction of the market. If the markets are going up, you should be in the same direction. You should be in the direction of northward journey. You should not be in the direction of southward journey. So never firefight with the market. Never doubt. Nobody is a full-fledged expert here. Nobody is a full-fledged expert to give advice. Everybody will make mistakes. But the early you identify your mistakes, the more you will grow your wealth. That is the motto of this session. So the two rules is always be optimistic, never be pessimistic in the market, especially when you are an investor. If you are a trader, you can be pessimistic, because traders' life is a completely different journey. We are also trader, we are also investor, but today's session will more focus on the investing journey rather than trading. If you are a trader, you can be pessimistic for short term, you can be pessimistic for 2 to 3 months, even you can be pessimistic for 6 to 12 months. But if you are an investor, you should never be pessimistic. You should always be optimistic with regards to your stocks or with regards to your investments. So these are the two rules which you should definitely follow. Again, I will repeat. First is you should be optimistic in the market. Second rule is never firefight in the market, or never go in the opposite direction of the market. See, in 2008, you can see in the slide, the lemon crisis happened where the market have hit the double lower circuit. But I have seen the people during those times, they started speaking pessimistic about the market. The markets are gone. Markets will never come up from these levels. Markets are now in the southward journey. Markets journey is over. The golden era of the journey is over. As far as I know, from the year 2000 to 2008 or 2010, that was the era of the information technology companies or the information technology stocks. The boom was there in the information technology sector. So the first recession came in the IT sector during those times, that is 2008, 2009. And everybody in the market became pessimistic. Nobody wanted to invest in the market. Everybody were leaving the market and they were closing their demat accounts and trading accounts. But as far as current market or current scenario is concerned, you should be very, very optimistic. No doubt there will be many triggers. You should be optimistic. If a person was optimistic in 2008 or 2009, you would have made the index was somewhere around 3,000, 4,000 level. Right now, the index of Nifty is somewhere around 18,000 levels. So almost the 5 times of the net worth is increased in terms of index. So that is the first thing what I wanted to discuss is whenever there is a negative time, analyze what is the reason behind that negativity, how much negativity it will be there, what is the time period for that negativity it will be there. Then only go and invest in this equity market. So try to analyze how to do it. We'll do it in the next slide. Second, after 2008, 2009, when the Congress government again formed, there was a bull market in the equity. Again, market started going up. In 2011, 12, market again felt some heat and started coming down. Then the Modi era came. The talks of Modi government formation in 2014 started, and then the dream run of the equity market started. Then again, people started coming into the equity market. No doubt, the numbers were less. From 2013-14, when the Modi government formed, the index have doubled from those levels from 2014 to 2016. The era was superb for the market. The overall returns were very, very good. Then again, 2016, everybody know what has happened. I know many of you have forgotten. In 2016, the demonetization period have come. Again, market have shown some negative reaction. No doubt, the reaction was very, very less. That is what I'm saying. Whenever there is a negative reaction, whenever there is a reaction of a negativity in the market, see what is the impact. The impact of demonetization was very, very severe. We know that it impacted the economy for 3 to 6 months. But we would have analyzed that this impact will not be there for much time, because there was no such economic crisis, or there was no such a big news that economy will collapse. It was a short-term hiccup which was taken by the government. And again, economy started building up from next couple of quarters. So that was the right time to invest. That is what I'm saying. Whenever there is a negativity in the market, first analyze what is the time period of that negativity. It will be there. Similarly, in the Corona period in 2019, 2020, when the Corona crisis came, the Corona crisis started from 2019 December, and it has impacted the Indian markets. In March 2020, 23rd March, I remember the date very precisely. 23rd March 2020 was the low of Nifty. Nifty is our Indian index, which is listed. 2020 March 23, 2020 was the low of the Nifty. That was a low made in the month of March. That was around 7,300, 7,400 levels. From there, from 2020 to 2021, in the year 2021, Nifty has reached the mark of 18,000. So you can see the returns, almost 150% returns in a single time period of 1 year. From March 2020 to 2021, in the middle of 2021, market have tested the all-time highs of 18,000 plus levels. I remember that date because my own birthday was on 24th March, so I wanted to invest in mutual funds. I wanted to invest more in the markets because of this crisis. So that was a low in 2020 March. That was very low, and that low still is not. It is not breached. So that is why you have to see what is the event that is happening, what is the time period it will last, and what will be the impact on the various sectors or on your portfolio. So those kind of things you have to analyze whenever there is an economic crisis in the market. Again, I will repeat, first is whenever you are starting your investment journey, either it can be your own investment journey, or it can be to your clients. So whenever you are advising to your clients with regard to the mutual funds or equities and all, The first and foremost is you should be very optimistic. Second is you never fight with the market. If markets are going down, wait for the opportunity. Wait for the market to come down. Wait for the market to stabilize on the lower levels. Wait for the event to go on, event to surpass, then only start investing. So that is the overall motto of showing this slide. That is the new era in financial market. We have faced the crisis in 2008. We have faced the crisis in 2014. That is a not crisis, that is an event, that is a Modi government formation. In 2020, we have faced the corona crisis, and right now we are facing the crisis of interest rate hikes. So these types of crises will come and go, these types of negativity will come and go in the market. But if you are an optimistic person, if you are a person of the equity market, if you are continuously invested in the equity market, I definitely know you would have made money, good money in the market. So this slide is all about being optimistic and never fight in the market. Never firefight the market. See, these are the three guru mantras of the current scenario investing. As I already told, there will be only three words which we'll be discussing: analysis, Indian market, and the current scenario. In current scenario, there are three guru mantras which we follow, and all we advise to our clients as well. First is market discount everything before. See, always remember this is an era of IT. This is an era of artificial intelligence. What you think is already thought by thousands of other investors, and what you are writing or what you are analyzing currently is already analyzed by the softwares. So never think that what you have think is not thought by any other person. So I'll give you one small example. Everybody know about electric vehicles. Right now there is a good charm which is going around electric vehicles. Me and everybody know about electric vehicles and what will be the impact of electric vehicles on the pollution, what will be the impact of the electric vehicles on the automakers and auto stocks and all. So once you go to the internet, once you go and type electric vehicles on the internet, you will find all the data. You will find which are the companies which are going to benefit, which are the companies which are going to get some negative impact of these electric vehicles, which are the companies which will be acting as suppliers for the electric vehicles, which are the companies which will do well in terms of electric vehicles. So once you type electric vehicles in Google, you will find all the data. So never think that you are the only person who are analyzing the market. Markets always analyzes before you start analyzing. So always remember, market discounts everything before. So one more example I wanted to give. In the time of Corona, when everybody were locked in their homes and we were also working from home and we have never opened the office for 3 to 4 months during that era. When the Corona was at peak, it was at peak during March, April, May in 2020 in India. You can see that statistics as well. In India, in March 2020, April 2020 and May 2020, the Corona period, the first wave was at peak and Indian markets were at highs. So many of our clients, they said that why Indian markets are moving up, why there is no panic in the markets when everybody is locked at home, when economy is at standstill, nobody is going to work, there is no employment, there is a crisis of money all over the economy. Middle class people are suffering, lower class people are not able to get the food, even the companies, the corporate companies are not able to find the clients. Then why markets are rising? So we have given a simple advice. See, this is a period of crisis. This is a period of to save your cash and to invest slowly. But markets will look 6 to 9 months forward. They will look 1 year forward. That what will be the world after 1 year? So markets have discounted those that this is a period that will end for 6 to 12 months. Definitely there will be the impact, but the impact later will be positive. As predicted by the market, market has bottomed when there was a Corona crisis peak in India. Corona crisis started in March 2020. The market of the bottom of the market has also formed in March 2020. You can see, go and see the statistics. It is you can see this clearly. See the bottom of the market and the crisis of the Corona on the first day was both at in the same month. The lockdown was kept on 23rd March. That was a low when Nifty has made in the equity market. So more than lockdown, there is nothing which government can do. That was already predicted by the market. So now, for first guru mantra is always you will see that market discounts everything before. There is nothing which markets will not discount. I also give one more example. I don't know how many people, how many of you are investing, but there is a company called Reliance, which is one of the biggest oil refinery company in India. Many of our clients, they say that whenever Reliance results come, the stock falls. So many of our clients say results are out, so the stock will fall, and it happens also. Even though the results are very good, the stock price falls on the result day. I'm not saying 10 after 10 times it will fall. 10 after 9 times, definitely it falls as per the history. The thing is, market has discounted the results before. They were expecting good results. Company has given good results and it has fallen. So always remember, whether it can be economy, it can be a stock, or it can be any event in the financial market or a financial world, the markets, the equity market discounts it before. And one more example I wanted to give. I don't know how many of you have tracked this crude oil movement. In 2020, crude oil went into negative territory also. Right now, it is somewhere around $101 per barrel. That is $101 per barrel. In the time of Corona, the crude oil prices went into negative. That means I think around -17 per dollar it has been. That means if you want to sell the crude, you have to pay the money. That is a clear disagreed concept in the market when crude has fallen below the zero level. That means nobody is a buyer in the market for crude. So these kind of scenarios also you will see in the market whenever you are investing in equities. The first and foremost rule is market discounts everything. Never say that markets have not discounted. Even if you don't think, even if you don't realize, it will discount everything. It will discount everything for next at least 9 to 12 months. Second is never try to predict the unpredictable. See, I have seen many of our clients. I'll give you the real example. Many of our clients have built positions in the stocks and have built the positions in many of in the indices, saying that the next government will be formed by BJP, and the next government will be formed by Congress. So that is the thing that is not in your hand. You can't predict a formation of a government sitting in a small room or a small office. Those things are done at the national level. Those things can't be predicted. So never try to predict the unpredictable. I will never try to predict any result of the company. Never try to predict any uncertain event. The uncertain event can't be predicted also. Even just you can analyze how the results will be. You can't even exactly predict how the results will be. So never try to predict the unpredictable. Predict only the things which are predictable. Like earnings, you can predict how will be the earnings. Like the next earnings season, how it will be for next 3 months. You can predict by seeing the current economic scenario. You can't predict the monsoon season for next 3 months. Can you predict? No, you can't predict a monsoon season. So never try to predict monsoon in the monsoon season, and never try to predict the unpredictable. So that is the second rule. First is market discounts everything. Second is never try to predict the unpredictable. If you go and try to predict, definitely you will burn the hands, because 90% of the time your predictions will go wrong, and it will be a simple gamble game. So that is the second rule. Third is never play on your luck or do gamble. See, I will give you all the real examples. Some of our clients, they say that let's go and buy stocks of 1 rupee or 2 rupee. Any stock which are, suppose there is a stock XYZ which is trading around 1 rupee in the market. They say that let's go and buy 1 lakh shares. Whatever we lose is only 1 lakh. And if the stock goes 5 or 6 rupees, we'll make 6 lakhs. So this kind of strategies, this kind of playing on luck or doing gamble, you should avoid, especially in the market, because no doubt you are ready to lose full of your capital, but this is not the right way to invest, because this is your hard-earned capital, this is your hard-earned money. Never try to play gamble, never try to play a luck with your hard-earned money. So never invest in penny stocks. Many of us in the period of 2020, 2021, many small stocks, 1 rupee, 8 rupee stocks have become 40, 50 rupees. But we have never, never advise our clients to invest in, because we don't know what is the background behind those stock movements. And again, in 2021, 2022, currently those prices have again come down. So anyhow, those things are part and parcel of the market. So never play on luck or never do a gamble. Again, I will repeat the Guru mantras for 2022 or in the current scenario. Market discounts everything. No, never think that market don't know what you are thinking. Always be a follower of the market. Never go against the market. Second is never try to predict the unpredictable. Never try to predict the monsoons. Never try to predict the governments. Never try to predict the uncertain events. Never try to predict the economic bodies. You can predict the results, but that also you can't predict 100% correct. Third is never play on luck. Never try to invest on luck or gamble. invest wisely after doing a thorough research. So these are the guru mantras, you should follow from 2022, because the scenarios completely change. In 2008 or 2009 or during 2000, the stock news or the prices or the events you would have known after market, or you would have known later in tomorrow's newspaper. But in the current market, you can see whenever a Reliance results is out, you will get the analysis in the next couple of minutes. So this is the era of artificial intelligence. Never try to discount yourself. Always be ahead of the market, but with the market, never go beyond the market. Again, I will repeat, always be ahead of the market and with the market, and never go beyond the or opposite to the market. Because if you go opposite to the market, definitely it will cost you more in this journey of investment. I'm talking about investment. I'm not talking about trading, because trading is completely different field. You can go against the market. You can have your risk reward in your mind. But in the terms of investing, you should never go against the market. So this is what I was talking about. Markets are now more matured. So what do you mean matured is, I will give you an example. If you go and invest in US stocks, in the United States stocks, I don't know how many of you are aware with the global markets. Just to give a glance, the US stocks are represented by Dow Jones, that is a Dow Jones index or the NASDAQ index. NASDAQ is a IT index of that, the more stocks are of IT in the NASDAQ, and Dow Jones is the 30 stocks industrial average, that is the index representing US. In the Europe, the major index is DAX, that is a Germany index, and in the Asian market, the major index is Hang Seng, which is a Hong Kong market, and the second major is the Nikkei, that is a Japanese market. If you compare Indian markets with the global market, that is the US, European or the Asian markets, Indian markets have not become more mature. Still, they are the more maturity is yet to come in the Indian markets, but in the US markets, most 90 to 95% of the market is mature. The Chinese market is also matured more than 90%. Even the Japanese market is matured more than 90%. But the Indian markets are still maturing. It is in the middle stage of maturity. Now, there is a huge discussion and there is a huge movement for. My simple rule in the market is you can't make easy money in the mature market. If you go and invest money in the US market, your chances of making money will be less, because everybody is mature, everybody is having the data in hand, everybody will not be able to get good money or get the good stock price in their favor. Second, you can't go and invest in Chinese stocks, or you can't go and invest in Japanese stocks. Again, the maturity level is very high and everybody knows the information. Everybody knows the impact of all the news. But you can make money in Indian markets because it is still into the maturity stage. Because still there are only 9 crore demat accounts which are active in the market. The population of Indian subcontinent is somewhere around 130 or 140 crores currently. And only 9 to 10 crores demat account are active. So still there is a huge scope of maturity in Indian markets. So whenever there is an immaturity, or I'm not talking about the knowledge term, in terms of knowledge term, I'm talking about the analysis term. In terms of analysis, there is some maturity which has to be committed to the Indian markets. So knowledge is very high. The people are people are studying, people are getting knowledge from various other fields. But the maturity level in terms of analysis is still at the middle stage. So this is a right time. This is a good time for all of us to invest in the market, because still we are into the maturing state, or we are not become mature. See, you can see in the slide, participants have become more educated now. Any news is analyzed and made public in seconds. I have already told you, if you just type electric vehicles in Google, you will get all the analyzed round the clock analysis at your fingertips. You will get all the companies which are there in the electric vehicles. You will get all the companies which are auto ancillary companies who are supplying parts to the electric vehicles, which are the companies which will be negatively impacted. Everything will get in a single day. So markets are now moving towards the maturity. Automatic trading tools are ruling the market. That is absolutely right. I don't know how many of you know, but in major of the metro cities, many of the people have started building algo trading. I don't know how many of you have heard this term. Algo trading are the automatic trading systems which are built by the technicians or the market participants. These are the automatic sessions or the automatic tools which are fixed into the system, and those systems do the trading on behalf of the client or on behalf of the trader or the investor. So this kind of automatic trading, automated traders is now active in the market. So if you are not updating yourself, if you are not started to implementing new strategies in your investing, then the road will be very difficult. The road will be very tough for you to in the terms of investing. See, I'm not saying never to be in the market in 24 hours. I'm not saying to be in the market for every time, every hour you see the markets. At least give 1 hour daily in the out of your working hours. Whenever you are idle during the evening times, whenever you are at home or at office after the market hours, just have a glance of the markets. Just see what are the government policies which are out, how our markets are performing, what are the global markets doing, where is the gold rate, what is the rate of the crude. At least give a glance to your portfolio, at least give a glance to the market news, to the global news, what is happening all over the globe. Because that will give you the glance that how markets are performing and how the things are going all over the globe. Because India is now into the global world, we are into the civilization of global, we are globalizing our economy. So you should be aware of what are the policies, what are the things which are happening in the global world also. It will not only help you in the investment journey, it will also help you to invest your clients who are coming to your office for various other advices as well. So at least give a half an hour or 1 hour time to just read the market news and how the markets are performing. I have seen many people in my investment journey, almost it is 12 to 14 years of my investment journey. They have their they have their portfolio, they have lakhs of portfolio, somebody is having 25 lakhs of portfolio, somebody is having 40 lakhs of portfolio, but they don't know what is how Nifty is formed. They don't know what is how Sensex is formed, what is the determination of Sensex, how Nifty is formed, what is the analysis behind the Nifty. Just to give a glance, Nifty is a 50 stocks basket. It includes the top fundamental stocks of the company, all the large cap stocks which are having more than 20,000 crores of market cap. And again, Sensex, it is a 30 stocks basket. It also contains the top fundamentally good stocks which represent various sectors. So at least give a glance what is the value of Nifty, what is the value of Sensex, and how our Indian markets are performing with regards to global markets. So whether you are there in the market, whether you are investing or not, just give a glance of the market, because that will help you to invest or to give advice to your clients. Next is data is now more transparent. I already told you data is available everywhere. And I guarantee in the next 5 years, data is the only thing which you can sell. Because if you are having a good data, if you are having a good research, if you are having a command on the market, if you are having a command on the research or the analysis part, that is the thing which will earn you. That is the thing which will keep you ahead of everyone. So data is now more transparent, and you should be available with the data every time. New regulations, I already told you, SEBI and NSE, BSE, every regulatory body, they are acting in a very proactive manner. All the regulations what are coming into the market are pro retail investors and pro market. So all the new regulations have given confidence to the new age investors. People are now more focused and careful. See, I already told you, people are now more focused. People who are not seeing their portfolio, who have just invested and kept the portfolio in the demat account, they are now more focused. They have now started seeing their investment. Now they have now started seeing what are the other parameters which are affecting their portfolio. See, I'll give one more example, which I usually give in all the investor awareness program. In 2022, there are two types of investors, there are two types of traders which are there. The investors and traders before 2020, the investors and traders after 2020. See, this is my real-time, practical thing what I have seen. Before 2020, the investors were very keen. They were very, they wanted to build the portfolios. They wanted to build up the wealth over a period of time. Post 2020, when the Corona crisis happened, many investors, many traders started coming into the market because everybody were at home. Everybody were locked in their homes, or they were locked in their rooms during their daytime. So everybody started coming into the market. It was because that was the only way they were looking to earn some financial freedom or earn some financial goals. So everybody started investing into the market from 2020. In 2020, 2021, the new millennials, what the new world which is devised by our media channels or everybody, The new age investors or the new traders or investors which came into the market post 2020, they have never seen the bear market till now. In 2020, in 2021, anybody who had invested in the market have gained. Definitely they have gained. In 2021 also market was good. In 2020 also market was at the lower levels. So the investors or the traders before 2020, they were more kind of conscious investors. They know what are the market volatility, how the markets goes on, how there will be volatility from top to lower levels. But in post 2020, the new age investors or the new traders or investors that came into the market, they have never seen the bear market. They have only seen the markets going up. That is why I have started feeling the pain, and the people who have invested in 2020, they have started feeling the pain, or people who have invested in late 2021, they have started feeling the pain in 2022. This is a live example. You can go anywhere. This is a practical example. You can go and ask any people in 2022, most of the portfolios are down. The people who have invested in 2021, seeing the bullish of market, seeing the returns of the market, major of the portfolios are down in 2022 because the rise of the market was very furious and the downfall of the market is also very furious in 2022. So that is why we can see a huge roar and pour in the market in 2022, that markets are falling, markets are not giving good returns, because the people who have entered in 2020, 2021, they have never seen the bear market. They have only seen the bull market. They have seen the prices, they have seen the portfolio, their portfolio growing 50, 70, 80 times also. So this is the first time in 2022, they are seeing the portfolio going into the red. So the things have changed. So your part of analysis should also change. That is what I already told. Analysis of your investment should change as per the times. In 2008, your analysis pattern was different. In 2014, your analysis pattern was different. In 2019, in Corona times, your analysis pattern was different because there will be no analysis during this kind of an economic crisis. In 2022, your part of analysis will be different. So that is what I am saying. A small advice to the people who entered into the market in 2020, 2021. Everybody said that mutual funds sahi hai, mutual funds are going good returns. They started investing in mutual funds, but their NAVs are down in 2022. So major of the people, even we have given advice to our clients to invest in mutual funds. No doubt those mutual funds are done well, but still they are not giving good returns because the markets are down. So never be pessimistic. Again, I will repeat, in 2022 also markets are down, but during the period of time, your investments will also grow as the economy grows and as the market grows. So invest in good stocks, invest in good companies, invest in good names, never investing hard on stocks, never invest in penny stocks and all. So the new investors in 2020, 2021 who came into the market, a small advice: never panic and never sell your investment in panic. Wait for the opportunity, and your investments will also grow in 2022, and it will grow more in 2023 as well. So never sell your investment in panic. Just a small advice for people who entered post 2020. See, again, this is the new era in financial markets. I have discussed most of the things. This is the important point: high volatility, high risk, and high returns have emerged. You can see the fourth point here. See, I don't know how many of you were in the market in last 10 years. In 2012, 2011, when Nifty was below 10,000, I have never seen Nifty moving more than 50 to 70 points in a single day, or 20 to 30 points in a single day. Max to max, it would have moved 70 to 80 points. The Nifty means it is an index, which is an Indian index. It used to move only in 40 to 50 points or 70 points in a single day. But if you see today in 2022, Nifty is moving more than 400 points. That is from a 20-30 points. That is not a 0.2% also. Right now, it is moving more than 2 to 3% in current in that single day. So you can see the volatility in 2012, 2008. Market used to move only 20, 30 points, 40 points, and it used to close at the end of the day. But in 2022, in the current scenario, markets are moving 300, 400 points. You can see that today's market also was bullish market. It has moved more than 240 points. The markets are closed more than 240 points higher. So that is the craziness of the market. That is how the volatility persists. So again, I want to request one more thing. If you want to invest, if you want to be in this market, you have to be a friend of the volatility. You should not be against volatility. Whenever there is a volatility in the market, be calm. Whenever if you are an investor, wait for the volatility to come down, wait for the markets to come down. Whenever there is a good correction in the market, go ahead and invest. So it should be a friend of the volatility. It should not be the enemy of the volatility. Volatility will be there. Even a ECG of a person, it will be in the haphazard manner. It will not be straight. If the ECG comes straight, then the person is dead. Similarly, in the market also, the market will be in the ECG manner. It will go up, it will come down. So you should not panic with that. So no doubt, nobody can catch the bottom. Nobody can catch the top also. So no expert or no person in the market is a guru to catch the bottom, or it is a guru to catch the top. The only thing is you should make your own rules. You should make your own rules of investing. My rule is I will invest whenever there is a 5% fall in the market. I will invest whenever there is a 5 to 10% stock fall in the stock price of a particular stock. Suppose I was having a strategy of Tata Motors. I always invest in Tata Motors whenever there is a price fall of more than 5%. I always invest in Reliance whenever there is a price fall of more than 5% in Reliance. So those kind of strategies you should use in these bad times of market. So never try to firefight with volatility. Try to be a friend of volatility. Wait the volatility to come down. Wait for the market to stabilize. Make your own rules. Make your own diary of the rules and start implementing it. And start implementing it without any hurry. Make clear rules and don't try to break those rules. So there will be high volatility, high risk, and high returns. See, I have seen people practically in last 2 years. Many people have started doing option trading. I am not against any option trading in this market. You should do option trading, but should not do a haphazard trading in this market. People have started doing option trading and started gambling in terms of money. Suppose they invest 1,000 rupees, they want the 1,000 rupees to become 3,000 in a single day. So that is not the definition of options. We advise our clients to do options only for hedging, and we advise our clients to do options sometimes for trading as well. But we'll keep all the other parameters in mind before going into the options. We'll create our own rules, we'll create our stop losses, targets, everything. So many new age investors, I've seen the college students as well. They have started doing options trading. They have their own mobile app. They have started doing options trading. Option trading is not bad, but you should not do without the proper knowledge. That is why you can see the volatility in the market is increasing. So whenever there is a rise or fall in the market falls in the same direction very drastically, because the new age investors or the new people who are there in the market, they'll start panicking. So you can go and check historically in last 1.5 years, the volatility has increased. The Nifty movement was somewhere around 50 to 100 points before 2020. Right now, the Nifty movement is somewhere around 200 to 300 points. Because the new systems have arisen, the new people who are trading in options, the new people who are trading daily have come into the market. So the rule is, first of all, you should not go to derivative. If you are an investor, never go to derivatives. Invest in stocks, invest regularly. If you are a trader, you can go to derivatives, but follow some rules. I'll discuss the rules in the next slide. So high volatility, high risk, and high returns, those things have come. So this is one more important line. Opportunities are high, but are for limited period. See, there are very, very less opportunities in the market right now, because whenever there is an opportunity, the automated systems or the people who are with the first-hand information or the people who analyze the information accurately, those people will encash those opportunities. So that in the new era of financial world, there is a high volatility, there is a high risk, opportunities are less and are for the limited period only. If you don't catch those opportunities, you will be left behind this investment journey. So that is what I'm saying. Whenever you get time in the market, whenever you have started investing in the market, give at least half an hour in the evening to learn about the markets, how markets have performed, what are the companies which are there in the limelight, what are the news, which are the companies which are doing well, which are the companies which are doing good business in these bad times. One more practical example I will give. I don't know how many of you are tracking. In the last 12 months, our inflation have from 3%, right now it is 9%. I don't know how many of our colleagues or how many of the attendees have seen it. I know everybody know that Mehgai has gone up and inflation has gone up. But when 3% inflation, right now the inflation is somewhere around 8.1%. And you can see the RBI have started increasing the interest rate. So whenever there is a rise in inflation, RBI comes into the picture and they start raising the interest rate to curb the volatility or to curb the cash into the economy. So whenever there is a increase in inflation, whenever there is an increase in the cost of the daily living needs, you will see the margins of the companies or margins of the corporates will come down. I don't know how many of you are analyzed, but this will be a good practical example. Go after these sessions, once see how many of the companies have reported a better margins from 2020 in 2021. How many of you have given a better margin in 2022? The last 2 quarters, how many companies have given better margins? I doubt 80% of the corporates have given margins which are below expectations, or the margins have come below the margin which was there in 2020. So these kind of things you have to analyze. Whenever there is a inflation, the margins of the companies will come down, the gross margins will come down, the net margins will come down because the expenses will increase. So you should find those companies whose margins have not come down or whose margins have done well in this bad times. So those kind of companies you should go and analyze in the last 2 quarters. So this is one kind of analysis which you can do if you want to invest in stocks or equities. Identify the companies which are doing good in bad times, because there is a saying in the market: the best investment is done in the bad times. Is done in the bad times only, and the worst investment it is done in the good times of any company. So always invest in a good company during their bad times, or don't invest in a bad company at its good time. Again, I will repeat: always invest in a good company at its bad time, and never invest in a bad company during its good time. So identify those companies which are given good margins in last 2 quarters in this inflationary pressures. So those kind of companies are expected to do well. This is one kind of example that's just why I wanted to discuss. Coming to the next slide. This is a very good slide. New age, new people, new market. I already told you many young people, the college people, the college guys, the college students, the new people who have joined the corporate world, who are getting the white collar job, they are entering into the market and they are creating more volatility. That is not bad, that is good, but I will request all those people, it is my advice for all those people to just have an analysis and just go into the market. Don't go into the market without an analysis. Second is, youngsters are keen to invest in stock. That is absolutely right. I have been getting queries from last 12 to 18 months. Many young people are ready to invest, ready to analyze. That is a good one. They prefer to invest directly rather than handing over to mutual fund. That is also true. Many new people, new investors or new youngsters, they want to invest directly into the equity. That is also good, but proper analysis is required. They are risk-taking traders and investors. That is also right. Many people, they want to become trader. They want to take risk and make money, but they don't want to become investors. That is a new age, new people, new market. Markets have started to find other ways of handling events. That is also true. I already told you Corona crisis was the best time to invest. No doubt this is not the right time for me to give these words. But Corona crisis was the time to invest. And if this kind of crisis comes once again, or if these kinds of news or crisis comes once again in next couple of years or any year, you should be ready with your capital to invest, because you have to learn with your historical trends how markets have performed during these events. So markets have started to find out the new ways of handling events. The way of analyzing markets have changed. That is already I told you. The people, everybody right now, they know technical analysis, they know fundamental analysis, though they know all the topics, how to do analysis of the corporate earnings, how to do analysis of the markets. But there is one more kind of analysis which you should do, which is there in the next slide. See, this is a slide which I added recently. See, in March 2020, you can see the slide. There were around 4 crore demat accounts, and many of the demat accounts were not active in 2020. But you can see in 2022, March 2022, there are more than 90 millions. That is a 9 crores. More than 9 crores of demat accounts which are there active. So almost the activity have doubled. So that is why there is a huge volatility. There is a huge movement in the market, because the number of participants have increased in the market. If number of participants have increased, there is more analysis which is happening. If there is more analysis, there is less opportunity for the market. That is what I have been saying. always look for the opportunities in the market, start analyzing quickly, start doing analysis for the next 6, 9 months or 12 months, because markets will not wait for your analysis. Market discount everything before. So this is a slide which I have added that is giving a beautiful information from March 2020 to current March 2022, from 440 millions demat accounts to 90 millions demat accounts. It is almost, the activity has doubled. So, and one more thing I wanted to add in this slide is, in the month of June, that is the last month, more than 12,000 crore worth of SIPs have come into the market. You can go and check the figures. 12,000 crores of worth of SIP has come into the market. This is not the small figure for any equity market. And you can see these kind of figures are coming from last 12 months. 12,000 is a single month figure. When 14,000 crores worth of money has come in 2021 in a single month. So many people have started coming into the market. They have started investing into the stocks. They have started investing in the mutual funds and SIPs also. I don't know. I know many of you know about SIPs. Just to give a glance, SIPs is you can say it is a systematic investment plan. You can start with a 500 rupees. You can go up to infinite amount, how much you want to invest in a single month. So that is one of the best way to invest. So you can see the trend of past 14 months. After this session, you can go and check the figures. The average daily monthly SIPs into the market is more than 10,000 to 12,000 crore. You can go and check the figures. These kind of SIP figures have never come into the market in last 20 or 30 years. I have not seen the market. More than 10,000 crore average worth of SIPs are daily coming into the market. That means more than 10,000 crores of worth of money is coming into the equities via SIPs, via mutual fund into the market. So that is why you can see our equity market are stubborn. They are not going down very drastically as the other markets are going. The main reason is the mutual funds or the mutual fund industry are pumping the money into the Indian equities. So there was a saying, I don't know how many of you follow foreign investors. In 2008, 2010, foreign investors used to rule our markets. But in the era of 2020, the Indian investors or the retail investors are ruling the market. So this is one of the proud moments for the Indian equity investors, also the retail investors, that we are now self-dependent in terms of Indian equity markets, and we are pouring more into the Indian equities rather than the foreign investors. In the last 12 months or 15 months, foreign investors were net sellers in the market. Every month they are coming and selling into the market, but Indian investors or Indian investors who are coming to the mutual funds, they are the net buyers. So this is the beauty of Indian markets. This is the glory for the Indian markets, that day by day our Indian retail investors are coming daily into the market. Just a small request, go and check the figures. They have more than 10,000 worth crores of SIPs are daily, or daily, not daily, the monthly figures are coming into the markets. So that is one of the good news. So active demat accounts have increased. That is why there is a huge volatility. So this is a good slide. Investing, it is not a one-day match. It is a test match. I already told you, whenever you are investing into the market, never invest in the market for 1 day, 2 day or 3 day. Invest for years, invest for decades, invest for months at least. If you are investing for short term, invest for months, invest for at least a year, or give some years for your capital to grow. See, I give you one practical example. During when Tata Motors was somewhere around 400 rupees, some of our clients, I have made those clients to buy Tata Motors around 450, 420. This is not an advice for anybody here. I have made our clients to invest into Tata Motors around 450, 420, even to our family or friends. The stock price came to 400. I again stated our clients to go and invest more in Tata Motors around 400. Stock price came to 390. Again, I went to our investors or the clients. Again, I told them to invest for 390. Again, the stock price came to 380. Now, investors were not ready to invest because they were not having confidence on the stock. But the thing is, we were having confidence on Tata Motors. We were having the confidence on the EV theme, the electric vehicle theme. The only one thing what we have analyzed in Tata Motors was 8 out of the 10 electric vehicles, the cars on the road is of Tata. If you go on the road in India currently, if you see 10 electric vehicle car, 8 out of 10 will be of Tata. That is a Tata Nexon and anything. So that is the first thing what we have analyzed. So we expected some good results on Tata Motors in the monthly sales. So on any corrections, we advise our clients to go and invest in Tata Motors, and that has currently you can see the price. It is more than 450. So this is not an advice. This is just a practical thing what we have done. So people were panicked around 400. People were panicking around 380 as well. So that is not their mistake, because this is a market. Market keeps on panicking us. But we should be ready with our goals. We should be ready with our targets and with our strategy with the stock. So with that strategy, we are done well deal with the Tata Motors. This is a one example that it is not a one-day match. It is a test. Should we keep on investing in good companies? What are the triggers which are awaited? If you are started investing in 2022, if you want to invest in 2022, what is a test match you have to play now? First is global inflation worries. Everybody know in US the inflation was somewhere around 2%. It is right now somewhere around 9%, more than 9.1. The recent figure is 9.1%. So inflation is everywhere. Post Corona or post Russia-Ukraine conflict, the crude oil prices have gone up and the inflation worries are everywhere. Russia-Ukraine war conflict, we already know those because of this war, the price of the essential edible oils, the crude oil, everything has gone up. Skyrocketing crude oil prices, rise in essential commodity prices, Fed policy rate hikes. I don't know how many of you know that as we have a Reserve Bank of India in India, Reserve Bank in India, US is having their own central bank called Federal Reserve. So Federal Reserve have started increasing rates in US. That means the interest rates have started going up in US. By seeing the trend in US, Indian Reserve Bank or the Reserve Bank of India also started increasing rate. So whenever there is a saying in the market, whenever there is a interest rate hike in domestic equities, the equities market will fall. But this news is everywhere. So that is why you are not seeing a big fall in the market, because everybody knows about it, that if there is a rate hike, there will be fall in the market. Always the market falls when there is an uncertainty and when there is a news which is not known. That is why I already told you, market discounts everything. Don't try to discount the market. Markets always discount the next 12 to 18 months of scenario. And the next trigger will be note of caution from the global policy makers. I already told you, Europe is facing crisis. It is facing crisis due to Russia-Ukraine conflicts. US is under the crisis of inflation. China is having their own COVID problems. Japanese economy is also struggling with their yen depreciating very drastically. Middle East countries are doing good currently because of the rise in crude. So everybody is having a caution note all over the globe. So those kind of things you have to watch if you have started investing in 2022. There is a recession fear. This is the one good concept. See, in US, usually there will be yield curve which will be drawn on the chart. Whenever the short-term yield curve inverses in the US, there will be a recession in the US post 6 months. In the month of June, the yield curve in US have inversed. So people are expecting a recession in the United States in November or December. So this is not a prediction. People are expecting, this is not a prediction from our side as well. So people are expecting, so we should also have a close eye on it. So recession fears are there in the market. People are expecting a recession in the US market in 2009, in the month of November of 2022. So let's see how it pans out and how the figures come. So there is a recession fear and COVID effects. See, COVID has gone in India. 80% of the fear of COVID has gone. I don't know if COVID is gone or not from the community, but fear of the COVID is gone. So COVID effects are still there in the market. There are many industries which are not evolved from the COVID calamities. So COVID effects will be there on the economy. So these are the things which will be impacted, which will impact your portfolio or investments. Again, I will repeat: inflation fears globally, Russia-Ukraine conflict, crude oil prices, essential commodity prices, the Fed policy rate hikes or the RBI rate hikes, caution from the policy makers all over the globe, the recession fears which markets are expecting post November, the COVID effects which are still there in the market. So these kind of triggers you should keep in mind before investing. I am not saying these triggers will keep a drastic effect on your portfolio, but this will definitely impact your portfolio. So you should design your portfolio according to it. These things just wanted to discuss. This is the best slide. This is types of analysis. So once you open YouTube, after this session, go to YouTube, type technical analysis. You will find thousands of videos on technical analysis, the charts, the candlesticks, what is the trend, what are the various things which people follow to predict markets. You will find thousands of videos on technical analysis. After technical analysis, go and type fundamental analysis in YouTube. You will again find thousands of videos on fundamental analysis. You can go and learn from those videos. You can go and learn from those technical analysis videos, fundamental analysis videos. But for me and for the new era, of investing, or for the new era of analyzing in 2022, for me, technical and fundamental analysis is good. But for me, the third most important analysis is sentimental analysis. That is, technical analysis is good, fundamental analysis is also good, but the first and foremost analysis you should do in 2022 is sentimental analysis. If the market sentiments are not good, technical analysis will not work, even fundamental analysis will not work. So first and foremost analysis which you should do in the market is first do sentimental analysis, see what are the sentiments in the market. If sentiments are negative, don't go and invest, wait for the opportunity, wait for the sentiments to become positive, and wait for the sentiments to get flattened. I'm not saying wait for the total sentiments to become positive, that everything will be good, then only I will invest. That is not the right thing to do. But at least let the dust get settled off. Let the sentiment get drowned out, let the sentiment get settled off, then only go and invest. So the third most important thing what I want to discuss today in this session is, after the previous topics, is technical analysis you should learn definitely if you are a full-fledged trader or investor. Fundamental analysis also you should learn. But the first analysis which you should do is sentimental analysis. Because if sentiments are bad, fundamentals will not work, even technicals will not work. You will, in the technical analysis, you will find major breakdowns, major stock price corrections whenever sentiment is bad. In fundamental analysis also, you will find the stock prices going down whenever sentiments are bad. Because if sentiments are bad, the price of Reliance will also come down, the price of other small companies will also come down. If sentiments are good, the price of all the stocks will go up, and the small stocks will also go up. So my advice for the new age investors or the new clients or the new traders or the investors is, first do a sentimental analysis, how the sentiments are prevailing in the market, then go for technical and fundamental analysis. In 2022, right now the sentiments are bad. Everybody know, people are talking about recession, people are talking about inflation everywhere. So the sentiments are bad, but those are not bad as it was there in January or February. The sentiments are now started becoming flattened. So these are the times when markets have started digesting all the bad news, and they again started going up. You can see the Nifty as well. The recent low in Nifty was 15,119 somewhere, 15,180 or 180. From there, the market is currently around 16,200 or 250. So almost 1,000 points move in the Nifty as well. So sentiments will not be bad throughout the year or throughout the quarters. It will be bad for a few months. Those are the few months which you should identify and invest in stocks. So again, I will repeat, before going to technical fundamental, do a sentimental analysis also, especially of the global markets and the Indian equities. So this is the chart which why sentiments are important. See, short run, there will be a knee-jerk negative reaction in the market. You can see here that there is a hyperjord manner of the stock price. This is a technical chart. But in the long run, the chart is completely bullish. It is going in the northward direction. That is why sentiments are very important. Whenever sentiments are down, whenever sentiments are negative, invest in those times and be a long-term investor. Invest on any corrections in good companies and good stocks. Never be you can never be a pessimistic investor or pessimistic. I think there should not be a word called pessimistic investor also, because there is no concept of pessimistic investor. If an investor is pessimistic, he will not make money, because investor will make money only when the companies do well, and the companies will do well whenever the companies are optimistic. So there should not be any word called pessimistic investor in your dictionary. You should be always an optimistic investor. If you are an investor, if you are a trader, you can be pessimistic because you have to play on the both sides, on the sell side or buy side. If you are a trader, you can be pessimistic, but for an investor, you should not be pessimistic at all. Now, this is the best, again, one of the best slides. Never mix trading and investing. See, many clients, what they do, are many investors which come to us or any advisor, they will buy the stocks for trading and they will convert those stocks for investments. Suppose they buy XYZ stock for 100, They wanted to take a risk of 5 rupees. Then when the stock price come to 95, they'll not exit it, they'll keep it for the investment. That is one of the best, worst habit which people do in the world of financial markets. From 100, when the stock price comes to 95, when you have decided that you'll bear only 5 rupees of loss, exit the stock. Don't try to firefight with the market. Again, the first rule comes, never try to firefight with the market. Try to be with the market. So never mix your trading and investing. Whenever you are taken any stock for trading, keep it for trading. Whenever you are taken stock for investment, keep it for investment and track the results. If the results are bad, if the company is not doing well, then only go and exit. Don't exit the stock when the company is doing well in terms of results, in terms of investing. But in terms of trading, keep a proper risk reward in your mind. So never mix trading and investing. See trend of global markets. Have a look of government policies. Note key Nifty levels on paper. Have a close eye on news flow. See, my sincere advice for all the traders or investors is just give a 1 to 1.5 hour more to the financial markets. Even if you are not in the financial markets, even if you are in a full-fledged accounts fields, even if you are in the full-fledged of taxation field, even if you are a full-fledged of corporate world or any other jobs or any other service, just give 1 hour to the market, to the financial markets. Just see how global markets are performing, how global equities are performing. Just have a glance on the government policies, what are the new government policies which are there, which have been implemented by the government. Just write Nifty levels every week, every weekend, whenever you are free. If you are an investor, just see how Nifty have given returns in past 1 week or 1 month. Always have a close look on the news flow also. What are the news which are impacting into the market? Because it is your own hard-earned money. It is your own client's hard-earned money. If you want to make your client grow, if you want to make your portfolio grow, first and foremost, you should be updated. So never invest and sleep or invest and forget. This is not the market of investment and forget. Gone are the days when people used to say invest in Wipro, invest in TCS and forget your capital will grow, your capital will grow 2 or 3 times. Gone are those days. These are the days of invest and track. Invest and forget days are gone. Invest and track days have come. So whenever you are investing in stocks, invest and track also. Don't invest and forget. See the global markets, see the government policies, see the Nifty levels, where the Nifty is trading, what was the Nifty last month, where is the Nifty currently, is your investment grown as per the Nifty levels, is your portfolio have grown when the Nifty has gone up, if the portfolio is down when the Nifty levels have come down. So whenever you are investing, you have to keep something as a benchmark. Suppose if I am a cricket player, I will keep Virat Kohli or MS Dhoni as my benchmark. If I am a batsman, I will keep MS Dhoni as my benchmark. If I am a badminton player, I will keep some badminton player as my benchmark. That is why whenever you are investing in equities, keep Nifty or Sensex as your benchmark. You should not underperform Nifty or Sensex whenever you are invested in portfolios. If Nifty value is down, if your portfolio value is down, that is okay. If Nifty value is up, your portfolio value is up, that is okay. But if Nifty is coming down and Nifty is going up, your portfolio value is still. And if your portfolio value is coming down, that is the word of caution for you. So always keep comparing your returns with the benchmarks. Keep comparing your returns with the Nifty or any other indexes which you track. Because without a benchmark, you can't track your investment portfolios. So always keep a benchmark in the market and keep tracking the global markets. Keep tracking the government policies. Keep a note of Nifty levels. Keep a note of Sensex levels. See, before 2008 or 2006, when my parents or the elders which used to see the market, they used to see the Sensex. They never see the Nifty levels. The older people or the elderly people, they used to see the Sensex value. But right now, in the 21st century, the people are seeing the Nifty levels, because the Nifty or the NSE is the more mature or more tradable market in India. So instead of going for Sensex, also go for Nifty as well. So track Nifty and Sensex both whenever you are trading in the Indian markets. This is one of the best slides. So always be updated with the outside world. I already told you, always have a proper mix of trading and investment. Whenever you have given a portfolio size, like suppose you want to invest 40 lakhs, give a 5 to 10 lakhs for trading, 30 lakhs for investment. And once you are exhausted with the trading capital, never invest more into the trading. Keep your investment money separate and trading money separate. So always have a proper mix. Never make trading position as investment nor an investment position as a short-term trade. Already told you, my client, he bought at 100, he kept a stop loss at 95, but still stock has gone to 80, but he had not exited because he had converted those trading positions into investments. So that is a mistake which you should do, which you should not do. Always have a proper mix of trading and investment capital. Always decide the ratio of capital. I already told you 80-20, 70-30, depends on your risk reward, what you wanted to give. So decide the ratio of capital between trading and investment. Never play with any stock when we don't have background knowledge of it. See, many people, I don't want to name any stocks, I don't want to name any companies here. Many people were going gung-ho on many stocks which were there in the wind business, which were there in the solar business, which were there in the electric vehicles business, and they started investing in those stocks, keep saying that government policies are going good in this sector, will invest in those penny stocks. They invested in the stocks of 3 rupees, 5 rupees, 7 rupees. They know that the company is not doing well, the company is into the losses, the company's management is still under lenses of various other regulatory agencies, but still they want to invest in those stocks because they are seeing that government policies will help. So these kind of playing with the stock prices, playing with the companies which are not more hurt, playing with the businesses which are not doing good and investing in those companies, those things will not be good for your portfolios. Invest in good names, invest in good companies, invest in companies which are debt-free or at least having a less debt, invest in companies which are having a good cash in their books, invest in companies which are leaders in their businesses, invest in companies which are having more than at least 10,000 crore of market cap, that you can say more than 5,000 crore at least, which will come into the mid cap. At least have a large cap company in your portfolio. Just wanted to give a glance. Any market capitalization below 5,000 crore is considered as a small cap company. 5,000 to 20,000 crore is considered as a mid cap company. About 20,000 crore market capitalization is considered as a large cap company. Market cap, everybody know. I think no need to discuss about market cap. Any companies who is having the market capitalization below 5,000 crore on NSE or BSE, that is considered as a small cap company. This is a definition. From 5,000 to 20,000 crore, any market capitalization of any company, that company is considered as a mid cap company. About 20,000 crore, if any company is having a market cap, that company is having a tag of large cap. And the thumb rule is, in a small cap company, high risk, high return. In the mid cap company, high risk, high return. In a large cap company, moderate risk and moderate return. That is the thumb rule. If you want to invest in low market cap company, your risk will be high because the business is there to grow. If you want to invest in large cap company, your risk will be less and your return will be less because the company is already grown. So that is the clear-cut logic in market capitalization. So always have a good thorough knowledge before investing in any company. See the market cap, see the analysis, see what the management is doing, what are the profit trends, how the margins are performing, everything you have to see before going and investing into the stocks. So never play with any stock by going onto the hard on street, that is a HOS, usually we call HOS in terms of market. Don't go with the hard on street market mind. Don't go and invest in the stocks by hearing from any other's mouth. Invest in the stocks either from your investment advisor or do your own analysis or any other public platforms where investment analysis is available. So don't go and play with your money in any penny stocks or any other small cap stocks without having proper knowledge of it. And this is again, you can see, don't let the market decide your price. See, buying price is decided by us. Suppose if I buy Tata Motors 400, that is decided by us, but the exit price is decided by the market, that everybody knows. So don't let the market decide your exit price. It is your money, you are decided the buy price, and then the exit price should also be decided by you. Don't let the market decide the exit price because that will ruin your portfolio. So the next thumb rule for the market in current scenario is the analysis thumb rule is, whenever you are deciding the buy price of the market, always decide the sell price of the market. Suppose you have bought Tata Motors at 400, decide the maximum loss which you can take and decide the maximum profit you want to take. Suppose I bought 400, I bought Tata Motors at 400. I want to take only 50 rupees of risk. I don't want to take more than 50 rupees of risk in the stock. I will keep 350 as my exit price on the lower side and 480 or 500 or exit price on the higher side. So these things should be your habit in your market. You should develop this kind of habit in the market. Whenever you are putting an entry order into the market, on the second, you should have an exit order into your mind. That is, if you are entering into the market at 400, always you should have a proper exit point also. Don't let the market to decide your exit point. Market will not decide your exit point. Exit point should be decided by you. If you let market decide your exit point, I think 80% of the time you lose your money. So whenever you are entering into the market, enter into the market with proper exit points also. It can be either in loss or either in profit. So just give you a glance, track your portfolio at least once in a day. That I already told you. Before, people used to say track your portfolio at least once in a week, or 15 days in a week, or 1 month in a week. But gone are the days. The way of analysis is changed. Track your portfolio at least once in a day. See what are the stocks, how the stocks are performing in your portfolio daily, because that will give you a glance that which companies have you bought and what is the news flow which is revolving near your companies. Do proper shuffling of the portfolio. I already told you, always have a portfolio in the mind. If stocks are not performing, if the companies are not performing, sell those companies and start investing in the other companies which are having good performance or which are doing good. Never be in love with your stock. That is absolutely right. Never love your stock, because you don't know when your stock will stop loving you. That is a clear-cut saying in the market. Never love your stock. Your stock can be good in next 3 months, but it can be bad in next 18 months. So never love your stock. Be with the stock, be with the company till the company is doing good. If the company starts doing bad for the couple of quarters, company is not performing, do exit and switch to any other company. So that is a good way of investing in the stocks. So that is a good quote. Never be in love with the stock, because you never know when your company or when your stock will stop loving you. So never let market to decide the exit price. I already told you, if you are deciding the entry price, it is you who have to decide the exit price also, whether it is in loss or profit. So keep proper knowledge of the earnings. I already told you, whenever you are investing in stocks, whether you are given your portfolio to any investment advisor or you have given your portfolio to your PMS or portfolio management services, if you are investing in 10 stocks, at least see how the earnings of those 10 stocks are doing. You should not be completely dependent on any investment advisor. You should not be completely dependent on your portfolio managers or any other persons. You should also keep a thorough track of your portfolio, of your clients which are with you, or of your own portfolio, or of your family's portfolio. So keep proper knowledge of the earnings, how the earnings are going, how the company is reporting their earnings. Everybody know company reports earnings 4 times in a year, that is every quarter. So keep a track of all those 4 quarters earnings. Okay, what are the factors which are affecting markets currently? Global meltdown. Everybody know Dow Jones it is melting. It is almost down 15% from tops. Heavy option positions. I already told you. 10 out of the 8 people who are active in the markets are option traders. Most of the option activities happening in the Nifty and Bank Nifty or any other stocks. Just a small practical example, if somebody interested. If somebody want to do a practical example, just go to NSE site post this session. Go to any Nifty strike option, or it can be 16,000, 60,200, any Nifty strike action. You will find that more than 1 crore shares are open. 1 crore shares are open in the derivative market in a single strike of option in Nifty. So you can see the activity there. Before the activity was somewhere around 10 lakhs, 15 lakhs, 20 lakhs worth of shares were there in options. You can see more than 1 crore, 1.4 crores of shares which are open, crores of options shares which are open in the market in the current period. So you can see the drastic increase in the open interest, drastic increase in the option position in the market. But those are also affecting the markets in the short term. Commodity prices, already told you, steel prices, edible oil prices, crude oil prices, all have skyrocketed. No doubt in the last 1 month, the prices have come down, but still the prices are very high. Rupee weakness, today it is at historic lows. Before this session, I have seen the price of 79.98. That is a historic low for rupee. I don't know what is the closing currently post 5 p.m. But 79.98 was a historic low. That is a 2 days low was a historic low. And I think 80 to 81 is the next level for the rupee weakness. That is one thing which is factoring or affecting the market. Next is FIS selling. Already told you last 1.5 years, FIS are continuously selling into the market. Not 1.5 years, you can say 8 months, FIS have been continuously selling into the market. It is the Indian mutual fund money or the SIP money which are holding the markets or at these levels. So FIS selling is one concerns for the market. Mutual fund support, I already told you, Indian markets is rallying the market. Retail traders, already told you, many people have entered into the market. So those are the people, those are affecting the market. Now, what are the rules or what are the things a trader should keep into the mind? Keep your correct entry point ready. If you want to buy a stock, keep it ready with your book. Keep correct entry and exit point both. Have a clear-cut risk-reward ratio. If you want to earn 8 rupees from the stock, have at least 4 rupees of stop loss or 4 rupees stop risk. If you bought XYZ stop at 100, keep a 96 as your stop loss and 108, 110 as your target. That is a clear-cut strategy. Keep a clear-cut risk-reward in your mind. Don't take leverage. Leverage is a kind of common word in equity. Leverage means it is a kind of loan or it is a kind of margin which a broker gives to any client or any investor. If you are having a 5 lakh worth of stocks in your equity, broker will give a margin of 10 lakhs or 12 lakhs for you to trade. So don't go and take excess leverage. You can take some leverage in the market, but don't take more leverage positions in the market because it's not the right time to take leverage. Maintain stop losses and target. I already told you, always maintain stop loss target. Never miss any entry or exit. I know entry is decided by you, or exit should also be decided by you. It should not be decided by the market. Don't fall trap for any positive or negative news flows. I already told you, many investors, many traders, if there is a positive news which is floating or which are flashed on television, they start jumping into the stock, they start jumping into the market, start buying the companies, buying the stocks. That is not the right way to go. Don't fall trap for any positive or negative news. Even if there is a negative news, don't go and sell. Even if there is a positive news, don't go and sell in panic. Wait for the market to stabilize, wait for the market news to digest, see the impact, how much impact it will be there in the short term or medium term, then only go and invest or trade. So don't fall for any negative or positive news flows in the market. Wait for the correct opportunity. That is the rule for 2022, and that will be the rule for next couple of years as well. So this is a new analysis or new things which you should do. And trade in highly liquid stocks. I don't know how many of people know liquidity. Liquidity is you should find more sellers, more buyers in the market. Many people in 2021, 2022 started trading in stocks which are not having buyers and sellers daily. Daily stocks used to go upper circuit, daily stocks used to go lower circuit, and people started investing in those stocks. That is a not right way to go, because once the stocks hits continuously lower circuits, your investment value will become zero. So trade in highly liquid stocks, trade in stocks which are having good buyers, good sellers daily into the market. Trading those kind of stocks, don't trade in stocks which are hitting continuous lower circuits or upper circuits. So trading highly liquid stocks if you are trading in equity market. This is one of the important slide, one of the mantra also which you can use. What are the key indicators to catch bottoms and tops? See, many people in the markets, they want to catch the bottom, they want to catch the tops as well, to buy and to sell. So nobody in the market will accurately catch the bottom or top, but they can at least predict 80% of the bottom or 80% of the tops. We'll see what are the factors which you can also do. Optimism versus pessimism. This is one of the best point which we follow at our advisory firm. Whenever there is a pessimism in the market, whenever there is 9 out of 10 people are talking negative in the market, that is the point where the market bottom will form. I'm not saying that this is a guarantee, but historically this has done well. Whenever there is a high pessimism in the market, whenever there is a high negative flow in the market, whenever people say that market is gone, market will not come up, that is the point where you should go and invest. Whenever there is a high pessimism, you should become optimistic, you should go and invest. I'm not talking about traders, I'm talking about investors. Whenever there is a negativity in the market, you can see in 2008, everybody became passive or pessimistic, markets have gone up. In 2012, everybody become pessimistic, markets have gone up. In 2016, post demonetization, everybody have become pessimistic, markets have gone up. In 2020, Corona crisis also, everybody has become pessimistic, and again markets have gone up. So whenever there is a high pessimism, high negativity in the market, that's the right time to invest, and that thing is happening in 2022 as well. So there is a high pessimism right now. So this is the right time for any investors to take a call on the market. When the whole world turns bearish, you should turn bullish and vice versa. That is the whole thing I told you, optimism versus pessimism. Never go HOS. HOS is hard on street. Street is a dalal street. Never go and invest in stocks which you heard by anybody's mouths. Go do your own analysis, do your own research before investing in stocks. FI's position in equities and derivatives. See, always track FI's positions in derivatives and equities. If you want to catch the bottom of the market, see when the FIs are more shorts. If the FIs are more shorts, if FIs are more pessimistic on the market, the highest level when the FIs become pessimistic, that is the right time for the market to form bottom. And when the FIs become excessively bullish, that is excessively they have taken the position, that is a time when the markets will start forming the top. So always track FIs positions in the market. You can get these FIs positions on any sites or any business sites or on nseindia.com. Those things you should track. If you are having a time, track it daily. Crude and rupee values, whenever crude and rupee values are at top or at lowest, those are the bad times to catch the bottom. Because right now rupee value at the historical lows, I think that will form the Nifty bottom. And crude oil price are at the historical highs. That will also be positive for the markets, because whenever the crude oil price forms a top and rupee forms a historical low, historically it is seen that markets will form bottom, and similar things are happening right now. Whenever crude is at low, that is at the lower levels, and rupee at the highest appreciating level, markets will form top. That has happened in 2021. Crude oil were at lower levels, markets were at 18,000 plus level. That is a Nifty value was somewhere around 18,000. So that is a practical example. You can see whenever crude was at lower levels and rupee was at 72, market has formed top. And wherever crude has become is at higher levels and rupee is at historical lows, market is trying to form bottom. So these are the things which you can track. Nifty PE multiple tracking, that is absolutely right. I think everybody know about PE, that is a price equity ratio. I will give you 2 to 3 figures which you should track. Nifty PV around 17 to 20 levels, around 16 to 20 levels, that is a Nifty PE. That is the best level, that is the historical lows for the Nifty PEs to try and go and buy the stocks. Currently, the Nifty PE is somewhere around 18 or 19. So this is the right time, 16 to 20, whenever the PE comes to 16 or 20, this is the right time to invest in good stocks. And whenever the PE goes to 25, 27, 28, those are the time you should be more cautious and wait for the correction in the market. So Nifty PE multiple tracking is also good for market. I'll give you giving you the levels. Nifty 15 PE around 15 to 20 is a good level to buy the stocks. Nifty PE in the range of 26 to 30 is a kind of you can say it is a top level of the PE. So that time you have to wait for the market to correct for investing more. So these are the things, these are the indicators which you should follow. You should be always optimistic. Never turn bearish when the whole world is bearish. Never go by hard on street. Track FI's position in the market. See the crude and rupee value daily. At least if you can't see daily, at least 3 to 4 days. Once in 3 to 4 days, see the crude and rupee value. Track the Nifty PE per multiple. You will find on any business site. Just type in Google Nifty PE value. You will get the Nifty PE. Invest in stocks seeing the Nifty PE as well. So those things you can do to catch the bottom some tops. And don't walk the talk in the market. I already told you the mantra for 2000, the investors post-corona period. Don't walk the talk in the market. Never try to catch a falling knife. There is a saying in the market. Whenever markets are falling like a knife, like one side, if markets are falling, never try to catch it. Wait for the market to consolidate on lower levels. Wait for the selling to stop. Then only go and invest. Don't get carried away with the expected news flow. Don't get carried away with the news flow of the companies or any other things. Wait for the news flows to get stabilized. Wait for the impact of it. Don't go and just take a position by seeing the news flow. Never try to copy others traders' trade. That is absolutely right. See, many traders, what they do is, if suppose there is a XYZ, there is a big investor in India. He has got ABC stock around 100 levels ABC stock. Seeing those ace investor, many retail people will also start buying that ABC stock. We don't know what is the portfolio of that ace investor, what is the total portfolio size, how many percentage of the portfolio he has invested in the stock, but we go and blindly buy those stock and keep it in our portfolio. That is not the right thing to do, because we don't know what is the portfolio size of that investor, how much percentage of the portfolio size is bought. We will have 1 lakh rupees or 2 lakh, we have bought total 100% of that stock. But that person who have invested in the stock will be having only 1% of their portfolio. If that stock becomes zero also, we lose only 1% of the portfolio. But if that stock becomes zero, our total portfolio will become zero. So never try to copy other traders or other investors' investment idea. Do your own analysis. If you can't do your own analysis, give it to mutual funds or SI in the SIPs mode. If you don't want to give it to mutual fund SIPs, go for any PMS managers or portfolio managers, or go for any investment advisors. Those people will advise you on which stocks and which sectors you should invest. So never try to copy others' trade. Your 1 lakh your 100% of investment can be 1% of the other traders' investment. So never try to copy the other traders' trade. Keep your quantity size in check. Always keep your quantity. If you want to buy 100 shares, buy slowly. Buy 50, 70, 80, 100. If you want to buy 2,000 worth of shares, buy it partly on any corrections. So that will keep your prices get average. And first and foremost thing is, before trying to measure your reward, measure your risk first. So never try to measure your reward, because right now 80% of the crowd who are new investors, they will say that I want to make 2 lakh rupees from this 1 lakh, but they will not see that they can lose that 1 lakh also. That is the 100% of the capital. So never try to predict the returns. First, predict the risk. How much risk you can take of that 1 lakh. If you want to take a risk of 50,000, at least you should have a reward of 2 lakhs. So before deciding the risk reward factor, first decide the risk factor. That is the one more thing which you should do before going into the market. Now, what investors have to do? Prepare an early investment plan. I already told you, there is no right time, there is no bad time for the market for any investor. Prepare a plan, prepare a notebook, say that 5% or 10% of your capital you invest on any correction, invest in regular basis. Add hybrid mutual funds, add gold ETFs, add debt mutual funds to your portfolio, have some exposure to inflation-proof asset classes like gold. Try to make use of volatility, invest on any correction in the market. So that is the first rule you should keep into the equity market. So just a crux of this session for an investor, that nothing is right and nothing is bad. If you want to invest in market, invest on every regular intervals and be optimistic and never firefight with the market. If you have gone wrong, accept you have gone wrong and exit the investment. And if you have gone right, be with your investment. So for a trader, it is a completely different field. So we're not discussing more about trader. We're discussing about investor. What traders have investors are not to do: never panic, never try to restructure your portfolio daily, never invest in high risk sector, never invest in hard on street stocks. Don't stop your SIPs in bad times. Keep continuous flow of mutual funds every month. Don't stop your SIPs in bad time. That is the one thing which investors can do. So this is all about this session. Just wanted to give a glance what investors have to do, what traders have to do. So this is all about the things what you should follow. We'll see. We'll try to do a session on traders as well, how traders have to manage the risk. This is all about investors. So I conclude my words with this.
Sir, we have a question, sir. In a question and answer session, sir. Shall we read, sir? You can read, sir.
I'll read, Santosh.
Okay, okay.
Just wanted to give sir has been talking since almost 1.5 hours. So I just want to give a 5 to 10 seconds break or a sip of water. Sir, you're comfortable? Shall we go ahead?
No, we are habituated. There is no problem.
So the first question is from Mr. Nitin. How do we get information about the number of SIPs and mutual funds in the market?
See, you will get, if you go to MP's site also, you can get all the information about what are the things, what are the number of mutual funds which are there in the market, what are the SIPs which are available in the market. I don't know how many of you know, but in the last quarter, April, May and June, SEBI has stopped the AMC, that asset management companies, to issue new mutual funds or to go for new SIPs, because they wanted to restructure some policies. So from July, you will get more new mutual funds coming into the market. So in the last quarter, there were no new mutual funds which are launched. So if you want to see the performance of the mutual funds, you could go to the mutual fund site at the AMFI site. You can see how many mutual funds are there in the field of equity, hybrid or gold. So you can got all those market activity on the AMFI site, AMFI.
Okay. So the next couple of questions from Mr. Bhupesh Kumar Dann, Chartered Accountant. Do you also see recession affecting India if Russian-Ukraine war drags for on 6 months from now? And regarding the overall monsoon was quite vigorous all over India, more than expected, and floods. Will rural demand keep the market in black, or it will react positively?
See, as far as recession is concerned, definitely it will affect India also. But we were analyzing the global GDP figures all over the world. India is still predicted to give a GDP rate of 8 to 9%, which is the highest in the emerging economies like China, Japan, or Indian subcontinent. So we are expecting some effect on Indian markets as well. But the only trigger which will drive the market will be the inflation. If inflation don't come into the control in India in next 3 months, then Indian equity markets will definitely underperform the market, underperform the overall global peers. So definitely there will be impact on the Indian markets of the recession. But we are not seeing a bigger impact or a kind of economic crisis. We will see a knee-jerk reaction for a couple of months in the market, but again, markets will start turning bullish. I am expecting market to do good from next month. Even from post-Diwali, the market should do well. And recession, it is not necessary that whenever there is a prediction of recession, it will come. There is a prediction, but it can come or it will not come also. That is part and parcel of market. But we are seeing some effect of recession in Indian markets also. You can see the IT companies' results, the results of TCS, Infosys everywhere. You can see the margins are coming down, the attrition rates are going up. Many people are leaving their jobs in these IT giants. So you can see some effects on these IT companies which do their business in US. So there will be some impact on the Indian companies, but I'm not seeing any bigger impact. And second question is regarding monsoons. Monsoons were very good. I doubt the monsoons were very bad. But the thing is the floods which are happening all over India. The floods will impact the rural economy definitely because the floods are seen all over major agricultural states like Maharashtra. You can see the floods. You can see the floods in Gujarat. You can see the floods in MP as well. So definitely it will impact the rural economy on the adverse side. It will not impact the rural economy on the positive side. And second knife is the inflation. If inflation goes up, I don't think so. Rural economy will start growing up fastly. So there will be, you can say, there will be negative impact on rural economy. But again, I will say 3 to 5 months will be the max impact. Again, after 5 months, this economy will start growing up. So I always say whenever there is an event, that event will last for only 3 to 5 months, and that is the right time for you to go and invest. So for 3 to 5 months, I am seeing an adverse impact, but not more than that.
Chairman sir, you are on mute.
Sorry. Sir, the next question is from Nitin again. Can you please repeat the Nifty PE guidelines? See, Nifty PE, these are not guidelines actually. These are the levels what we have noted and in our Excel sheets. In 2000, during demonetization in 2016, Nifty PE has come to 16. That is, Nifty PE multiple has come down to 15 or 16 levels. That was the time when Nifty formed bottom, and again it has gone up. In 2008, Nifty PE has come to 10 also. That was the lowest level which Nifty PE has seen. So as far as our Excel sheet, as far as our research is concerned, on the lower side, Nifty PE multiple of 15 is the rock bottom for the market. On the higher side, Nifty 28, Nifty PE multiple of 28 or 30 is the top for the market. So lower side 15 is the bottom, on the higher side 30 is the top. This is the range for the Nifty PE multiple. For an investor, if somebody want to invest in stocks, whenever Nifty PE comes to 15 or in the range of 15 to 20, that is the right time to invest. And whenever the Nifty PE comes or goes to 28 or 30, that is the time to be cautious and wait for the correction in the market. Okay. So next question from Janardhan sir. What is the ideal asset allocation strategy for a practicing chartered accountant? See, there is no ideal asset allocation for any profession or any individual. For every individual, there will be a completely different kind of asset allocation.
If a client of an age of 23 years come to me and say, I want to build an equity portfolio, 80% of its money I will put it in equity and 20% I will put it in debt, because he is the person who can take the risk. If a person of an age of 45 or 50 is coming to me to build a portfolio, I'll keep a 60% of the equity and 40% in the debt. If a person of 70 plus is coming to me, I'll keep 80% in debt and 20% in equity. So there is not a proper asset allocation which you can do. But if you are in an early stage of investing, if you are in an early stage of growing, keep your 70 to 80% of your portfolio or investment corpus into equities only. I don't expect equity to underperform the asset as other asset classes. So 70 to 80% of your equity portfolio should be in equity. If you are a new age investor, if you are starting in your early ages, I think equity should do well. And second is you should always invest in gold and debt also, because whenever there is a talk of recession, everything, your gold and debt funds will do well. So you should have a mix, and mostly if you are a new age investor, start investing more in equities. That is 60 to 82% you should be in equities only.
Okay. The same continue question, sir. What are your views on REITs and INVIT, InvITs, sir? What is your view?
So REITs and InvITs are good. That is a proxy player for you to invest in real estate sector. But right now there are no such major REITs which are listed. Only Embassy REITs is there, one of the major REITs which is listed in the market. So REITs are a good way of investing in the market. Before going into the REITs, I'll first advise you to go for a mutual fund or SIP. If you already started investing in mutual fund or SIPs, you can even go for REITs as well. So one REITs which I know is Embassy REITs. That is a good one to invest in equity markets.
Okay. Thank you. So Vishal Maheshwari says, great session. Request your views on the trading platform like Zerodha, Anand Rathi, etc., which you believe is efficient and adds on convenient in terms of access and service.
For Vishal, I want to say that I don't want to recommend any broker here or any platform, because this is not the right platform, right thing to do here. But I'm seeing the online platforms, the online brokers which are there in the market. I not name those brokers, but those online platforms are good. You can go and trade with them, because those online platforms are even doing well. So as far as trading is concerned, it is more about the platform. As far as investing is concerned, you will do a buy or sell in a single day or single week. So I'm not suggesting any broker or any platform here, but all the platform, 90% of the platforms are doing well. The thing is, your portfolio should be stagnant. Always daily check your stocks, whether your stocks are coming into the portfolio or in your demat account or not. You can be with any broker in India. You can be with a small broker or a big broker. But one thing which you should follow is you should keep your demat account checking daily. See that your stocks are coming to your demat account. See that your trading accounts are getting settled daily. So you can be with any broker, but do give a regular check to your demat and trading account.
Okay. Thank you, sir. Bhupesh sir says, do you expect DIIs to be dominant forces in market and FII to be second fiddle?
See, there is no expectation. Already DIIs are dominant in the market. In the last 12 months, FIIs are nowhere in the market. Only DIIs are dominating. Rather than DIIs, I'm seeing retail traders are also dominating in the market in the last 6 months. Retail traders are building huge positions in the market. So I'm expecting DIIs flows to continue also. Once the FIIs are back into the market, still they are selling. I'm expecting them to be back post Diwali or in 2023. If they are back into the market, I think our market should rally vigorously in the next 3 or 4 quarters. So I'm expecting both DIIs and FIIs to do well. And DIIs are already, what you can say, they are already dominating the market.
Okay. Is it, Hanmantlu sir asked, is it advisable to be investor or selective shares or a trader for long-term investments?
It is advisable to be an investor of selective shares or trade. See, I already told you, if you want to be a long-term, if you want to be in the market for more time, you should invest, you should have a perfect mix of investments and trading. If you want to give a 5 lakh worth of money into the market, give at least 3 lakh into investments, because those investments will grow as the time and market passes. Because as the market grows, your investments will grow if you invest in good stocks. Always give a chance of trading also, because trading is also good for any creation of wealth. But before going to the trading, have a proper knowledge of trading. What are the tools which you have using? What are the analysis which you are using? I already told you into the slide. Technical and fundamental analysis, you will find thousands of videos on YouTube, but sentimental analysis you will not find anywhere. It has to be done by you only. That is why before going into the trading, start investing first, build a good portfolio, build a good money out of it, and then go for trading. Use good tools, learn good tools for intraday trading or short-term trading, then only go for trading. So my first advice is you should be into the investment field, don't go for trading. If you are going into trading, go for cash trading, don't go for derivative trading. Again, if you are going for derivative trading, keep proper target and stop loss. Because derivative trading, it is like burning your hands. If you don't have any knowledge of derivative trading, you will burn your hands in a single day also. So never invest, then go for trading without any proper knowledge. Go for investing first.
Okay. Sir, Satish sir asked, can you name few books on technical analysis?
See, there are various books on technical analysis which you can go or which you can learn. And this platform, I can't recommend those books, but once you go and type in Google, you will find many books like Mark. There is a book with the name called Mark. You can go and read that book. That book is good. That book is good for your technical analysis. Even some Indian authors have also written some good books on technical analysis. You go and have a look out of it. For fundamental, there is only one book, which is the Bible, The Intelligent Investor. You can just type it on Google for fundamental analysis. That is the best book. The Intelligent Investors. You can go and search on Google. That is a book which every investor, whether you are investing in market or not, you should definitely read that book. That is the Bible for financial market. The first big book you should learn is Intelligent Investor. And second is go for the technical analysis book. You will find it on Google, or I will share it with Deepak sir. I will share some books with them.
Sir, just to add on to this topic, our institute has started one technical certificate course, post-qualification course on technical analysis and fundamental analysis and equity research. The batch is the third batch is going to start on 23rd July, which I also joined. And why I included here is Institute has prepared a beautiful material. I think 5-6 years back itself, I have downloaded it. I think it is very vast and very useful material. If anybody want, you can contact me if it is not available in the website. Thank you.
Thank you, Ravi.
And one more thing I wanted to add. If somebody wants to do a fundamental analysis, I already told you The Intelligent Investor, that is the best book. If somebody wants to just learn about the market technicals, then the book of John J. Murphy. That is, he's one of the Murphy, M-U-R-P-H-Y. That is the best book to do a technical analysis, to learn about technical analysis. These two books, one can have a thorough glance, which will give a background of technical and fundamentals.
Okay. See, after the Carvey fiasco, members have a doubt that will our trading platform are safe for long-term investment, or do we keep our shares only in the demat account or the bank demat account?
See, after that event, after the Carvey event, the SEBI has come out with a stringent rules. If you just type it on Google, the pledging of shares. If you want to pledge the shares now, if you are broker want to pledge your shares, you will get an OTP on your mobile. So without your OTP, a broker even can't sell your shares or pledge your shares. So just your shares are safe with your brokers, your shares are safe with your demat account. Just a small exercise you should do every day or whenever you buy a stock. Whenever you buy any stock on a day, just after 6:30 or 7 in the evening, just go and check your demat and trading account, whether shares are credited or not. And it should be in your demat account. It should not be in the pool account of any broker. Pool account means should not be in the account of broker. It should be in your own demat account. So whenever you buy any stocks, you just check your demat account at the end of the day after 7 o'clock or 8 o'clock when the overall transactions are settled. If your shares are with your demat account, your shares are safe and there is no problem with your investment money and both shares. So there is nothing to panic here. So just check at the demat account whenever you buy the shares at the end of the day.
Okay. Raghavendra Reddy sir asked, which is the best indicators for trading in index FNO?
See, there are many indicators. I will give you 3 indicators which me and my team use. Those are the moving averages, Bollinger Band, and the RSI. I think you can just Google it on your system. Again, I will repeat: moving averages, 21-day moving average, 50-day moving average, and 100-day moving average. These are 3 indicators. Next is a Bollinger Band, BOLLINGER, Bollinger Band. That is one of the technical indicator. Third is the RSI, Relative Strength Index. These are the 3 indicators which me and my team uses in our office in terms of technicals. In terms of fundamentals, usually we follow few parameters. Some 2 or 3 parameters I will let you know. First is company should be debt free. Second is it should be a sectoral leader. In whichever sector it is, it should be the leader. And third is it should be having a minimum market cap of more than 10,000 crore. So these are the 3 main parameters which we see whenever we advise to our clients or any other people who are related to us. So these are the things which we see.
Okay, sir. Vijay sir asked, how do we choose stocks? Do you suggest any good screener?
See, there are many good screeners which are available publicly on public platforms. There is one site called screener.in. It is one of the good sites which I also do post. I will again repeat: screener.in. This is one of the good sites. Even you can go for tijori.in. That is also one of the good site for seeing the screener, but that is a paid version. Tijori is not the free usage. Screener.in, you can use it for free. That is one of the good sites for you to create. You can create your own screeners as well. So I'm not recommending any company for screeners, but these are the good screener sites which you can go. And there are more free screeners also available. You can type it in Google. It is available on Money Control also. It is available on Business Standard as well. So you can just go and search it. You will find out on public platforms.
Okay. So the next question is from Janardhan sir. You had said at the time of entry, you should decide the exit price. Whether this principle applies also to the long-term investing, like very good stock like Asian Paints, ITC, etc.
See, that is one of the wonderful question here. See, I already told you the era of investing has completely changed now. No company is a good company for long term. No company is a bad company for long term. Even for long term investing, also you should have a correct entry and exit point. Suppose if I want to invest in Asian Paints, you have selected a good company. That is also one of my favorite company. Suppose the Asian Paints current price is 2,800. Whenever price comes to 2,600, I have one entry point. Whenever price comes to 2,400, I have my entry and one more entry point. But I don't have an entry point around 2,200 because I don't expect the price to sustain below 2,200. So at 2,200, I will have my exit plan. On the higher side, if the stock price go to 3,000, I will have my entry plan. If the stock price goes to 3,200, I will have my entry plan. So entry and exit plan should be there for both short-term trade and also the long-term trade, because current markets are very dynamic. Nothing holds good for long-term investment as well. But if the company is doing well, if the company's quarters earnings are doing well, you should give 3 to 4 entry points rather than exit points. Exit points should be given. It should be given at the lower levels. So it depends from company to company, but both for long-term and short-term, you should have an entry and exit point both. For long-term, you can have multiple entry points and one exit point, but for short-term, you should have one exit point only and multiple entry points. That is the motto. You should have both entry and exit for both short-term and long-term investments also.
Okay. So it's almost nearing 8 and last questions as of now. Can you, sir, repeat the site name once for screening, what you were recommending?
Yes, the site name is screener.in, screener.in, screener.in. It is developed by 2 to 3 traders or the investors, 2 to 3 partners. The site is very good. You can go and just have a look. I'm not recommending the site officially, but the site is good for creating the screeners and seeing the screeners there.
So I think no more questions for the day. Over to you, Secretary.
Thank you very much, Chairman sir, for reading all the questions and answers. Sir, my sincere thanks to you, Speaker of the day, Arun Kumar Mantri sir, for your elaborative and practical and most relevant explanation and session. You can see the number of participants never decreased 100. Thank you so much, sir. My sincere thanks to all attendees who are continuously listening to the session, and my sincere thanks to the chairman Deepak Ladda for inviting such a beautiful speaker for this fantastic topic. Thanks to Hyderabad branch for conducting this virtual program. Thank you, sir. Thank you, everyone.
Sir, Ravi, sharing of the
please.
certificate.
Yeah, sorry.
Sir, this small. Yeah, please, Ravi. Go ahead.
Sir, please. This is our virtual thank you certificate.
Small token of gratitude on behalf of managing committee members and Hyderabad branch members. Sir, please do accept it. And looking forward for a physical session in times to come. Request members to come join in large number in physical also, so that as we had almost 110 plus, so it's a very good number after so long time. This shows, and sir, you have drastically means covered the subject of all asset class with in-depth. This shows your command on the subject and the trading, and wish you all success and hope, and take our fraternity and become the next ace investor like Rakesh Junjunwala from our fraternity in the days to come. With all best wishes from our Hyderabad side, and request you to please take out time for the members of the CA fraternity more often. And that is the reason sir has been called on all the national channels, CNBC, Awaaz, and all other big channels regularly. So we request for your more sessions in the days to come. Looking forward. Over to you, Secretary. Thank you.
Thank you. Thank you so much, Secretary. Chairman,
Thank
sir.
you, members, for joining in large numbers today and making it a very interactive session.